let's start off with the overall markets picture right now and get your view on the rally that we've seen, of course, falling back yesterday. Was this just profit taking, or are you concerned around the rising risk aversion globally and what that means for the local markets?
Once again, thank you for having me on your show. I think the Kenyan market is definitely going to be reeling in line with what's happening on global markets. A bit of profit taking, but yesterday there was actually strong demand for some of the blue chip counters. And this demand was highly driven by the foreign funds. 72% of the trades that went through yesterday were actually executed on behalf of the foreign companies. So in as much as there's a global risk aversion for Kenya, it's not as much as for the other markets.
Mbithe, let's just focus in on the banking sector right now. Of course, we saw KCB rather, not equity, KCB falling back yesterday as it went ex-dividend. But KCB, of course, has been one of the top performers on the exchange this year, and very much a case of a state-owned bank that has really come to the fore. And this is an interesting trend that we're starting to see in Africa, where you've got, even in Ghana and the west of the continent, state-owned banks have really risen in prominence and able to take on the likes of Barclays Bank, Standard Chartered Bank, Stanbics, and the likes across East and West Africa.
Indeed, an interesting phenomenon and an interesting time for the likes of KCB. A lot of interest, especially because of the fact that they have a new management team on board, and we have a strategy that's actually pushing out cost efficiencies. You have a state-owned bank that's becoming more of a private kind of bank in terms of its operational and its products that it's offering to the market. And what's interesting is that cutting across the continent, if you go to Ghana, you have a Ghana Commercial Bank that's also on a transformation agenda similar to KCB. The only difference is that it's about 8 months behind. So we have companies that are very strong in their countries that are going to emerge as strong Pan-African banks that are able to compete against the standard multinationals, the likes of Barclays and Standard Bank.
The rise of ETI is also an interesting one that we're tracking right now, because it has ambitious plans across the continent, of course, buying Oceanic Bank in Nigeria. Now, ETI has given EcoBank Kenya a fresh injection of 2.1 billion shillings. EcoBank, of course, a lot smaller, it's unlisted at this point in time, but what does this mean for the banking sector as you have ETI being a lot more aggressive in East Africa right now?
I think all these banks are becoming sort of Pan-African in terms of their operation. ETI coming out of the West and coming into East Africa is a positive for them in terms of driving the Pan-African strategy. Though I think the difference between the West African and the East African banks is that the East African banks are very knowledgeable in terms of retail banking, which has actually been a deficit across the sub-Saharan continent. If you recall, I mean, the banking levels are pretty low, and I think the winners eventually will definitely be the Pan-African banks that are able to first understand retail banking and able to extrapolate that into corporate banking. So I think the East African banks have a competitive advantage in that regard.
Do you believe that East African banks might start moving into the west of the continent? Is there scope for them to do that? Of course, a very saturated market in Nigeria, but overall, as you say, they've got that competitive edge when it comes to retail banking.
I think it's a proposition that anybody would want to be looking at, depending on the multiples in terms of what prices you'd be willing to pay to get into this market. Another thing would be regulation and the kind of operating environment. West Africa is very different from East Africa, at least even on a basis of culture. You have the West Africans, people from Nigeria are very aggressive, very abrasive. People from East Africa are a bit laid back. But I think the fact that most of the things that have been happening in the banking sector are becoming automated, then if you can be able to go to Nigeria, for example, and set up a bank there, or be able to get a license there if the regulators permit, then you can be able to roll out a retail banking strategy based entirely on your automated systems and a rebranded image that's not coming out as a Kenyan bank. For example, I think, last week we had a Pan-African conference. We had lots of companies there, and we met a very interesting company called Cellulant, a Kenyan-based company that offers mobile banking solutions. Now, what's interesting is that this company is actually offering sort of like an M-Pesa product for the agricultural sector in Nigeria, where the government is able to give virtual tokens for money for fertilizer acquisition in Nigeria. Now, these people are being brought into the formal sector by the automation of such services by the government in Nigeria, and this becomes a proposition for the banks to be able to extend retail banking products in that region. So I think if you're an East African bank and you're looking at what mechanisms automation and mobile banking platforms can offer, then you can be able to get synergies from the East and the West in that sense.
Fascinating use of mobile banking there, as you say, very innovative. Let's take it back to Kenya right now. Of course, M-Pesa is Safaricom's mobile banking innovation. In terms of the whole issue around mobile termination rates, it really seems to have escalated right now. You've got Safaricom and Telecom Kenya on the one hand that are saying that they need to have fresh studies into the mobile termination rates, and then you've got the other, Airtel and U Mobile, saying that the sector should continue on the reduction path as planned. How's this going to plan out? Because it seems to have got quite messy, and you've got an arbitration situation panning out right now where all the telecoms operators have to sit in a room and try and come to an agreement of some sorts.
I doubt if anybody wants to be the first one to comment on any messy affairs, but I think what we're seeing with Safaricom, in as much as it's following up and trying to see how much clout it can be able to have on one end, you're seeing that it's becoming innovative in terms of rolling out its M-Pesa product and trying to see what other transactional revenue streams it can generate out of this. So I think it's in a position where, yes, this is something that could or may not happen in terms of the interconnectivity rates being revised, but on the other end, it's still been trying to push revenue by enhancing its M-Pesa content in terms of how many transactions you can be able to pull off the M-Pesa platform.
So I know that obviously Safaricom is one of your buying stocks at the moment. You're looking at those full year results that came out, pretty muted numbers there, but a tale of a better second half, 4% year-on-year drop we saw for the full year numbers in terms of that earnings per share. Tell us about the reason that you think Safaricom's still a buy at 350.
For one, the second half numbers were very strong for the last reported year. The revision of M-Pesa was definitely a key thing for them, as well as the revision of the tariffs. I think what we are seeing is that Safaricom is still going to continue operating as a monopoly, and the fact that it's going to be able to extend its transactional revenues not only from M-Pesa but into data, which is a new and growing, very strong growing revenue stream, for us becomes a key component for the company. And we think at the current price levels, it's definitely a buy and worth looking at again for the next 12 months.
When is it going to move beyond that IPO price level, because still trading at a discount to that?
Demand and supply dynamics, which I'm not in control of. We'll just wait and see, and we'll be keeping tabs on that.